Welcome back. In this video, we are continuing with the concept of uh with the standard rather IFRS 16 leases, and we'll be looking at sales and leaseback for today. In the previous video, we looked at the features of a finance lease, how to determine the present value of lease liability, what is the fair value of a lease, the calculation of depreciation, how to determine current and non-current liability that should go to the statement of financial position, and what should be the finance cost going to the statement of profit or loss. We briefly also touched on the concept of short-term leases, and we promised that we were going to be looking at the concept of sales and lease back. So today we would be discussing the concept of sales and lease back using this question that was examined by ACCA in December 2023 in their strategic business reporting exam. Um, at the end of the video, you should be able to assess whether a transfer between a lessor and a lessee qualifies as a sale. What will be the accounting treatment if it qualifies? What will be the accounting treatment if it doesn't qualify as a sale? And then what are the accounting entries, or how do we journalize those transactions? And then before we jump into the concept in earnest, I wish to remind you that the question that we're going to be dealing with is in the first comment in this video, and the slide that I'm using here is attached in the second comment. So what I would advise is that you pause this video meanwhile, download the question, read through the question, and then you come back and continue listening to the video. We will not be spending time to read the question out to you, but after reading through the question and making the necessary notes, then you come back and listen to this video to see how we have dealt with the concept. And then besides, we want to also look at what is a sales and leaseback. In the previous video, you find that if you want to lease an asset, you don't want to buy them outright. You go and lease an asset from the owner of an asset called a lessor, and then you pay um, some form of premium, let me put it that way, and we call it the lease rental that you pay to the lessor. Then we now say, okay, if you pay it substantially over the life of the asset, that would be a capital or a finance lease. If it is just over a short period, that might be an operating lease that we explained in the previous video. But in a sales and lease back, you already have an asset. Let's say you need a truck that helps you convey your goods from a point of purchase to your warehouse where you sell, and then you have urgent cash flow needs in the business, and you are unable to go to the bank or unwilling to go to the bank to borrow that money from the bank. You can choose to sell this asset to a lessor and then lease the asset back. So let's assume that the asset would generate 8 million pounds if you sell it, and you are just going to be paying 500,000 pounds a year in your lease rental. What you can do is you sell the asset, you get the 8 million, and then you pay 500 pounds as the rental for the lease. What that has helped you achieve as a business is that it has helped you release at least 7.5 million in cash flow to help you deal with urgent needs in the business. So, but sometimes when businesses transfer assets to a lessor, it might not qualify as a sale, you know, because some critical benchmark or criteria has not been met. They have just used it as a cover to borrow money from the lessor instead of selling the asset outright and leasing it back. So if you want to assess if the transfer of an asset from the seller lessee to a buyer lessor qualifies as a sale, what you would do normally is to use IFRS 15 as a guide, which is one of the standards we have also said we are going to be dealing with. You know, IFRS 15 has about 5 steps where you use to determine if a sale has taken place. Like you look at the sales contract, you look at the if they say what is the content of the contract between the seller and the buyer, what are the performance obligation. You look at if the performance obligation has been met and at which point we recognize revenue. So if you use the 5 steps guidance to determine if a sale has taken place, then we are satisfied rather that you have transfer. If you are the seller lessee, you transfer the asset to the buyer lessor, and therefore you are able to lease it back from the person. So if the seller has satisfied the performance obligation by transferring the control of the asset to the buyer, we are convinced that the sale has taken place. When we say transfer of control from the seller lessee to the buyer lessor, what does the term control mean? It means that the ability to direct the use of the asset and obtain all economic benefits from the asset has been transferred to the person that is buying the asset. If the sale contains a clause that you are supposed to buy back the asset perhaps over a short period of time, that would make it obvious that this was not an outright sale. If also the seller lessee retains the benefit, like you maintain the repairs of the asset, you pay like insurance premium, and the income generated from that asset comes back to you, it means that you have not sold the asset. You have taken a loan instead of selling the asset and leasing it back. So this, if you were to deal with this in exams, you want to say that for us to know if a sale has taken place, we are going to be looking at the guide in IFRS 15. But principally, we should be sure that the seller has satisfied the performance obligation by transferring the control of the asset. The performance obligation here will be that the buyer has paid, and then we have also transferred the control of the asset. And the control of the asset here is that you are able to direct how the asset is to be put into use, and the benefits that should come from the asset over the useful economic life has been transferred to the buyer lessor. In that instance, we are satisfied that a sale has taken place under sales and leaseback. Now, if a transfer from the seller lessee to the buyer lessor qualifies as a sale, what will be the accounting treatment? The first step is that since you've sold the asset, you derecognize the asset from your book, then you record a profit or loss on disposal. Then step 2, because you've leased the asset back, you recognize a lease liability by recognizing the right of use of the asset and then the present value of the lease payment, the future lease payment that you are yet to make. This second part, we've already dealt with it in the initial video, which you could go and have a look at. But in these 2 steps, or involving the accounting treatment, there are 3 things that we have mentioned: the concept of the right of use, the present value of a lease liability, then profit or loss on disposal. Of course, for the right of use involving sales and leaseback, what we do is that we measure the right of use as a proportion of the carrying amount of the asset that you sold or transferred to the buyer lessor, and then the lease liability is the present value of all future lease payments that you're supposed to make. Then the profit or loss is determined based on the proportion of the rights that you've transferred to the buyer lessee. All of this, we are going to be looking at it using the Benito question. So, but the two main accounting treatment is that if a transfer qualifies as a sale, you recognize the asset and recognize the profit or loss on disposal in your profit and loss account. And then you record the lease liability by determining the right of use and then also the present value of the lease liabilities. Now, if the transfer between a seller lessee and buyer lessor doesn't qualify as a lease, meaning that I have said earlier that the rights and associated with the asset has not been substantially transferred to the buyer lessor. So in essence, we now treat it as if the money the buyer gave to you was a loan. So instead of you selling the asset to the buyer. And if that happens, the accounting treatment is that the seller lessee continues to recognize that asset, the carrying value of that asset in the statement of financial position, and then the proceed, what you receive from the sales and leaseback arrangement, should be treated as a financial liability applying the requirements of IFRS 9 financial instruments. So instead of recognizing lease liability, you recognize financial liability because you received loan instead of selling an asset and leasing it back. So if it transfer doesn't qualify, these are the two steps in the accounting treatment. Now we go into the Benito question, which I believe that you've read through the question. If you've not, go to the comment section, download the question, read through, then you come back and continue. But the key things you're going to see in that question is that number one, the fair value of the assets that has been sold is 6.75. The carrying value of the asset is 3.75. The cash that we received is 7.5. I want to draw your attention to something here. Ideally, an asset should be sold at its fair value because already we have the carrying value being 3.7 and the fair value is obviously higher than the carrying value of 6.75. So the carrying value was 3.75 and then we have the fair value of 6.75. But you see that the cash we received from the buyer is 7.5. Once this happened in a sales and leaseback arrangement, the difference between the cash received, especially if it is higher than the fair value of the asset, we treat that difference as an additional financing. It's like that additional amount is a loan that you took. So in this case, the cash received is bigger than the fair value. What if the cash received is lower than the fair value? Meaning we treat it as if you made an advance payment to the buyer lessor. But in this case, this illustration shows that we have received an additional cash. So the additional cash in excess of the fair value is like a finance or additional loan that you received. So how do we treat it? So this additional finance is excess of cash received. We need to take it off by saying the 7.5 million cash less the fair value, we have 0.75. So if you look at the question, we were told that the present value of future lease payment is 5.47. So this 5.47 includes 0.75 excess cash that you receive. So we want to treat it as if the actual present value of the lease payment is 4.72. The present value of the lease payment recognized in the question that you were told minus the excess financing that you received from the buyer lessor because they paid 0.75 in excess of the fair value of the lease. I want to say again that if they paid lower than the fair value of the lease, you want to treat that as an advance cash payment the to the lessor. So that means that what we're going to be recognizing as the present value of the lease payments in this question is 4.72. So these are the key information that we've extracted from that question. In an exam scenario, I recommend that you extract it this way so that once you're applying them, you know exactly how to where to place each figure. Then we said if a transfer qualifies rather as a sale, the first thing that you do is that you derecognize the asset, then you recognize a lease liability by recognizing the right of use of the asset, then calculating the present value of the lease here is being given of the lease liability is being given onto us. Then what we need to calculate is the right of use and the profit or loss on disposal. So in this question, we are assuming that the transfer qualifies as a sale. Then we are leasing back the asset. So how do you determine the right of use? We said in the previous slide that as a proportion rather of the carrying value of the asset that you have transferred to the lessee. So you determine that by there are several methods, but I've decided to use this simplified approach. First, by determining what I call the right of use percentage. And how do you do it? You do the carrying value all over the fair value of the asset multiplied by 100%. That becomes the right of use percentage. And in this question, our carrying value, we've established that it is 3.75 and the fair value of the lease is 6.75 multiplied by 100. That means that approximately the right of use percentage that we are supposed to recognize is 70%. And how do I do that? We take this right of use percentage and multiply it by the present value of the lease payment, and that gives us 2.62. Then how do we recognize the profit or loss on disposal? So here, obviously, you've seen that the fair value is bigger than the carrying value. Therefore, we have made a profit. So if the right of use percentage is 70%, it means that this is a proportion of the asset transferred. Then we are now going to be, returned by the by the seller lessee. Therefore, the proportion of the right transferred is the remaining percentage, which is, let's say, 100% minus 70%. That gives us 30% to make 100%. So what we want to do is to say the 30% that is left multiplied by the total profit from this sale. Total profit from this sale was 6.75 minus 3.75. That gives us 3 million. And you take 30% of 3 million, that gives us 0.90. So we've been given the present value of the lease liability. We now know the value of the right of use, and then we also know the amount of profit that we have made from that disposal. The next step now will be what will be the accounting entries. So we are going to be debiting the cash that we received, that is 7.5 million. The right of use of the asset, we also debit it. On the credit side, because we are supposed to de-recognize the property because the transfer qualified as a sale, we de-recognize the property, we write off the carrying amount from our value of property, plant, and equipment. Then you recognize lease and financial liability of 5.47. You can do this in two steps rather. You say lease liability 4.72 and then financial liability 0.75. And the difference between these two will still give us the 0.90, which is the gain on the right transfer or the profit on disposal. So in a nutshell, that is how to recognize sales and leaseback. I'm going to do another illustration on sales and leaseback when there is a modification in an asset in the next video. So, but if you want to get back to me, you can, reach me on this mobile number or this email for additional question or any way you think that I can be of help to you. But thank you for listening, and see you in the next video. Thank you.